allow just some more folks to enter it, and then we will go ahead and get started. So 12:02 will be our kickoff time here as we wait for just a couple more folks to come in. All right, then. Thanks again for joining us today for our topic, refinancing. And when does a cash out refinance make sense for you? And when does really a refinance ultimately make sense? Let me introduce myself. My name is Grant Spencer. I am the mortgage branch manager here for the folks in Rochester. And today, just a couple of quick ground rules, if it's okay. During the session, if you have any questions, feel free to go ahead and add them to our chat box below, and we'll be able to answer for those for you as we go through. And I have to say, this is a topic that's near and dear to my heart, which I have loved and appreciated for years, using this kind of service to help people put themselves into better financial situations throughout their lives. And I'd like to start with a couple of quick introductions across the board. First, I'd like to start with Mr. Michael Zuber here at Michigan First Mortgage. He is a loan officer with us for quite some time. Mike, why don't you introduce yourself?
Yeah, hi, my name is Mike Zubor. I've been working in the mortgage industry since 2013. Detroit resident, lived in Michigan my whole life. Big time Detroit sports fan, and really just playing sports. And one of the big things I've done here that drives a lot of my referrals are making bagels for my clients, agent partners, and other folks in Michigan First branches.
And it's very true. If you have the opportunity to connect with Mike, he makes a really mean bagel. I don't think anybody really touches how good good bagels he makes. So thank you for that, Mike. Appreciate that. Next, I'd like to go ahead and introduce Logan Peters, a loan underwriter here with Michigan First. Logan, why don't you tell us a little bit about yourself?
Well, let me start off by saying I'm not nearly as athletic as Mike, but I can assure you that my passion does lie in finance. I've been working for credit unions a little over 10 years now. Been working in my current role as a consumer loan underwriter here with Michigan First for a little over a year and a half now. Prior to that, I was a loan officer, or what we call a financial sales representative, for about 2.5 years. And yeah, I'm just privileged to be here. Thank you again for the opportunity.
Logan, it's good to have you aboard, and I know that our members will appreciate your insight when it comes to how we can get a loan done for them from an underwriting standpoint. So today's topic is refinancing, cash out, or what we call a rate and term refinance, to go ahead and put a client into a better situation. As I talked about before, this is a topic near and dear to me. I've been doing this for a little less than a quarter of a century with members and with borrowers across the board, and I would tell you that there's really very few mechanisms that would allow a borrower to go ahead and totally, completely change their lives the way a cash out refinance does. Today, we're going to be talking about a couple of questions and topics that kind of lead down that general line. It'll be a conversation. Please, if you have questions, feel free to add them to the chat box and we'll answer them as we go. Mike, I'd like to start off with you and throw the ball your way. And the question is, what's the difference between a cash out refinance and a rate and term refinance?
Yeah, for sure. Great question. So cash out refi. This is a refinance where you're going to be leveraging the equity in your house. So maybe there's an addition you want to put on your house. Maybe you've racked up some credit card debt. Essentially, what this is going to do is leverage the equity that you may have in your house. Housing values have increased significantly really forever, right? And this is an opportunity for you where maybe you have some high interest debt that you need to pay off. You can leverage the equity that you have in your house to pay those debts off. Where a rate and term refinance, this is where you're going to be. Like it says, you're looking at your rate, you're looking at the terms of your loan. So, oftentimes it's in your best interest to do and look at the rate. If you're in a higher rate than where the current market's at, you can get into a lower rate, or, you can spread out your payment over a longer term or a shorter term to, either pay your mortgage off faster or to lower your monthly payment.
Yeah, you're right on with that. You can really utilize a refinance to change a person's life a lot of times. I know that in the past we've used that to pay off a great deal of people's consumer credit card debt, pay off vehicles, give them cash out to pay for things that their family needs, such as college education for their children, going ahead and paying for weddings. Right now, the MBA had just sent a report out to us that as of last year, there's $4 trillion in untapped equity within homes across America these days. So, as it was many years ago, there's a real piggy bank there for Americans to go ahead and put themselves in better financial situations across the board. Mike, you kind of talked about rate and term refinancing as well as a way to go ahead and drop a client's payment for themselves. Right now, with rates being a little higher these last couple of years, we're expected to see rates come down in the next couple of years going forward. How would a rate and term refinance go ahead and help somebody reduce their monthly payment if they decided to do that?
Yeah. So, you have an opportunity to buy down the interest rate. You have an opportunity to spread that payment out over 30 years. Like, let's say you're at a situation where, you're 15 years into your mortgage and, you no longer can afford the payment anymore. That balance has been paid down quite a bit by, looking at the terms of your loan, spreading that, what's left of your balance out over 30 years can make a huge impact in what you're paying monthly, get you back on the right track. And like Grant was saying, we're expecting rates to start dropping here in the next couple of years. We've been kind of in an increased market. Rate and term refinances are going to probably come back into the fold, especially for anyone who's purchased a home during this higher rate period. They're going to really benefit from a rate and term refinance come soon.
Well said. Well said, Mike. And, we talked a lot about, when somebody purchases a home, right? Part of the refinance process is an appraisal to go ahead and determine what the value of the home is at that current time, as someone who would normally do during the purchase of their property as well. And I want to hand this one over to Logan because during the process that somebody purchases a home, there's a difference between an inspection and the actual appraisal for that property as well. And Logan, can you kind of define for us what is the difference between an inspection and an appraisal?
Yeah, absolutely. Great question, by the way. I find that in the consumer loan sphere for our home equities and things, I find that these terms are often conflated. So an inspection is going to be done primarily for the interest of the prospective buyer. That's going to be by a third party. It'll be an inspection of maybe you want, is the HVAC system up to date? Are the mechanicals, the plumbing, are those things? You're going to want to gauge what am I walking into as a first time or maybe a future home buyer. What sort of problems if any, am I going to be inheriting? Now, an appraisal is something that we as the lender are going to be conducting because we are trying to assess and we're trying to identify what is the real value of this property in this market at this exact point in time. And obviously appraisals are only good for the time that they're conducted. As you mentioned before, home values have gone up over time and that's a historical trend. So just because an appraisal is conducted today doesn't mean that that's going to be the value forever. Obviously that's going to all be affected by market conditions. And ultimately the lender is going to use that appraisal to base the loan terms off of how much to lend against. And it also is an indicator of the financial health or at least the well-being of the individual homeowner because it gives you an idea how much equity is actually in the property.
Really good answer. And as a licensed appraiser myself, I'd like to just expound upon that just a little bit. Is ultimately, from the standpoint of a borrower, when they come to go ahead and do a loan, realize that your home's value changes over time, and it's based upon similar homes in your area and how much they have sold for. Now, this is just a snapshot in time of what you could potentially go ahead and sell the home for. It's from that the lender is going to use and base that off of to be able to determine how much they're able to lend to you based upon the value of your home. Now, even better for folks that have been in their homes for the last, say, 5 or 6 years, traditionally across Michigan, we've seen values of home go up 40, 45, 40, 50% in certain situations, depending on your marketplace. So if you had purchased prior to COVID, there's a really good likelihood that you've got a lot of equity built up in your home that you could take advantage of a refinance to put yourself in a better situation. And that's a kind of a good segue as we talk about it. So, Mike, I've kind of got a question for you when we talk about the housing and equity. How does a lender determine how much equity that a borrower may have in their house, and how much they can access?
Right. So, I mean, there's some different guidelines, whether it's a primary residence or it's an investment property. But, generally, we're going to do an estimate up front when we're first talking about the loan. We're going to get a conservative estimate on where the home value is. Maybe look at some values of homes that have sold in your neighborhood. Maybe look at the Zestimate on Zillow. But ultimately, what it's going to come down to is an appraisal. So, once you get into process for your mortgage, especially on a cash out refinance, we're going to be doing an appraisal on the property, and not us specifically. We're going to be working with a third party appraiser, a neutral third party. They're going to go out to your house, and like Logan was saying, they're going to look at comparable sales in your neighborhood. They're going to be looking at, bedroom sizes, how many bedrooms. I mean, Grant could probably go, being a licensed appraiser, into the full nitty gritty of what they're looking at. But simply put, they're going to come out and figure out what the value of your home is. So for a primary residence, generally speaking, you're going to be able to access up to 80% of that equity. Now, something that's important is, I'm sorry, not 80% of the equity, 80% of the value of the home. Because something that's really important to realize is it doesn't mean, okay, I get 80% of the value of my home. You're going to have to, we'll determine what 80% of the value of your home is, and then we're going to have to pay off any liens that are on the property. So we're going to go and pay off your current mortgage, and then whatever's left over is what you would have access to. Obviously, also, there's going to be some closing costs associated with it, but that's how we determine, what you can leverage.
It's a really good answer. And I think, again, another, conversation piece over here with Logan when we talk about, the appraisal and why we do it as a lender. So a lot goes into when we lend to somebody, because ultimately, as a member of Michigan First, we want to be a good steward of your dollars, but still be able to provide to all the rest of the members in regards to what we can give them to put themselves and their families in a better situation. So, Logan, from a lending standpoint, why is an appraisal conducted when somebody's either purchasing or refinancing to decide whether or not they want to do a cash out of the equity within their home?
Well, anytime you go to touch the home's equity, the question becomes how much equity is going to be in the property. And so that's why we're going to ultimately need an appraisal. We need some kind of benchmark, some kind of reliable resource to tell us what is the value of the asset we're dealing with. And it may be a little funny to think of the home as an asset, but similar to a car or anything else, that's exactly what it is. It is a hard asset that you own that has a value ascribed to it that is volatile may not be the right word, but it is subject to market conditions and changes. And so when you're going to tap into that equity, you have to have a place, you have to have something to base that estimate off of and how much you're actually going to be able to tap into. And to kind of piggyback off what Mike was saying, 80% I find is really about the golden number. Obviously for you guys in the mortgage team, 80% is the best, or that's really the threshold for the cash out refinances. There are fringe circumstances that we could do a home equity loan at a higher LTV, or excuse me, a combined loan to value. But really the gold standard, we're going to be trying to hit that 80% mark or cap it out at that point. Anything higher, you really need to start having like a very serious reason to draw that much equity out. And a lot of that comes down to we're trying to make sure that we're doing what's best for the member. And it's never a good idea to fully leverage an asset like the home, for example. You know, they always say don't bet the farm. If your combined loan to value is too high, and you know, like if you're at 90 or more CLTV, if something happens, you know, because life happens and it's unpredictable, if you had to sell that home, it starts to become very difficult because by the time you pay for closing costs and everything else involved in it, being too leveraged on that property could really put you, the borrower, in a bad situation. So again, here at Michigan First, we're just trying to do what's best for our members. And so we really try to make sure we're not going above 80% loan value unless we have a very specific and good reason to do so.
It's an excellent answer and very detailed as well. So that, you know, as a member, we all realize what positions we want to be in so that we can set each other up for success for any type of financing that we do. And again, a good segue back here to Mike, because we talk about, you know, scenarios where it makes sense to go ahead and maybe do a cash out, or what we call in the business a rate and term refinance that we kind of mentioned earlier in the presentation, where we talk about just simply paying off the existing mortgage and giving a borrower a lower interest rate on their mortgage in the long run. Mike, can you talk a little bit about what scenarios it might make sense for someone to do a rate and term refinance?
Yeah, so I mean, a rate and term refinance it's the scenarios are really just going to be when you want to lower your monthly payment. Like, we're always going to need to see some sort of net benefit in order to do so. I mean, obviously, it's not going to make sense to go to a higher interest rate if you're not changing the terms of your loan. So ultimately, I mean, I think it makes sense when, you know, maybe something has changed. Maybe you've, you know, lost your job and you've gone and had to take on another job where you're making less money, or, you know, your other expenses have increased and you no longer can afford your monthly payment. That's when, you know, it's going to make sense, or it's going to, you know, you're going to want to look into possibly doing a rate and term refi, just so you can lower that payment and, you know, kind of weather the storm.
I mean, very true. And especially over the last couple of years, with interest rates being historically higher than they have been in the last 10, 15, once rates come down in the next couple of years, it's probably going to make a lot of sense for folks who've gone ahead and purchased homes in the last couple of years to take advantage of lowering the interest rate that they currently have on their mortgage to put themselves in a better long-term financial situation. And now let's talk about the other side of the coin. And I'm going to go back to Mike again real quick with this one. You know, Mike, let's talk about certain scenarios and some of maybe your previous borrowers where we've had the opportunity to do a cash out refinance for them, and why that makes sense and what kind of things we can do for borrowers.
Yeah, I mean, the cash out refi, I mean, you know, leveraging your home's equity is oftentimes the lowest interest rate you're going to be able to get. I mean, if you're sitting on, you know, credit card debt, student loan debt, you know, these debts that carry very high interest rates, being able to roll that into your mortgage, you know, at a 6.5, a 6.75 is going to be a heck of a lot better than paying 30%. I mean, if you're sitting in there with credit card debt in the tens of thousands, I think that's a really important time to look at, hey, what can we do to kind of bring this down? Because when you start getting into those elevated levels of credit card debt, and if you're only able to make those, you know, minimum monthly payments or just a little bit over, I mean, you're really never going to crawl out of that without doing some sort of consolidation. So that's when really you want to look into like a cash out refi. You know, leverage your property's equity to get that lower interest rate to pay that debt off for you. And I mean, the other thing too is it can really improve your credit score and your health, your credit health, just because you're going to be lowering, you know, your debt utilization.
I'm wondering if the members had all seen Logan and I shake our heads yes to your response when you were going through that, because that's absolutely the case. If you look at some of the projections, if somebody paid the minimum payments on a high credit card balance, some of the numbers that we see in the industry talk about them not being able to pay off that credit card balance for 40 years, when you can go ahead and roll it into your mortgage and knock it off at a lower interest rate much faster and efficiently. And And Logan, let's talk a little bit about why would somebody want to draw equity out of the home when refinancing or taking a second lien, or is consolidation a right discussion for them? Let's talk about that.
Well, I would start off by saying if you find that your consumer debt, that would be anything like any unsecured loans you've taken out, any sort of credit card debt that you have laying around, you would need to do kind of like a self budgeting and figure out, am I servicing this debt? Am I comfortable with my current financial situation? Do I have enough to pay for my bills and then the things I want to do? And if you're finding that you're coming up short month after month, you may want to start considering, how much debt am I servicing? What is the interest rates that I'm paying on this debt? And would it make sense to consolidate this and get it all paid off? And I think most people, especially this day and age, they're going to find that yes, it does make sense to do so, because as Mike was pointing out, some of these consumer cards, like your store charge cards, these have interest rates of 35%, upwards of that even. And that is a significant amount, because you're going to have this debt no matter what, whether it's consolidated or whether it's broken up into individual consumer accounts. You may as well get that consolidated into one single payment and have a much lower interest rate, because it becomes a lot more realistic to get yourself out of that, because you have a home payment regardless anyway, right? So you either consolidate or you don't. But again, it's gonna come down to how much debt the individual person is currently servicing. And I would say if you find that your utilization, which is the amount of credit that you're utilizing out of your total available capacity, if you're at 40% or higher, consolidation is really something you should start thinking about.
That's a really good rule of thumb to think about 40% of your utilization. And for the folks watching, what Logan's referring to is how much of your credit card balances are you using? If you have $1,000 credit limit on your credit card and you say you're using more than $400 of that, and you're carrying that balance, which is 40% utilization in that example, that's when you want to start thinking about, does a cash out refinance make sense? And that's what we do call it in the industry, is a cash out refinance, to kind of just put some general numbers around it so that you understand if your home was valued, let's say at $200,000, the maximum cash out on a mortgage that you can get would be 80% of that value, or a loan of $160,000. Let's assume you had a $60,000 existing mortgage. We would take that away from that, meaning that in the end, you would potentially have access to $100,000 to go ahead and consolidate or use for other things for you and your family. Renovating the home, putting a child through college, doing a wedding, et cetera, and at the lowest rate possible, really, in lending across the board. So that kind of brings us to this conversation of whether or not it makes sense to do a cash out refinance on the first mortgage or simply take a home equity line of credit. And Mike, I'd like to talk about that. What's the kind of difference? What do you look for in whether or not it makes sense for someone to do a cash out refinance versus just doing a home equity line of credit?
Right. So, I mean, some of it really dives into looking at what the current mortgage is on the property. If you're in a situation where, you've got a very low interest rate on a high credit, a high mortgage balance, it may make more sense to look into a HELOC. It may make more sense to look into a HELOC if you don't know maybe the scope of the project. Maybe there's a project that you want to do on your house and you don't know how much it's going to cost. You don't know if you're really going to rack up a charge all at once. A HELOC is more almost like a credit card with a low interest rate that's leveraged by the equity in your home, where you can have that open line of credit to use when you need it, and you're only going to be making payments on what you draw. So, a cash out, I think, is a better option if you're looking to pull out larger sums of money. If the interest rate on your first mortgage isn't maybe super in a very low spot, where a HELOC is going to be a better bet when sorry, I just kind of lost my train of thought there, but a HELOC may be better for lower loan amounts.
Right. And I think that's a really good point. It comes down to how much you're looking to borrow at the end of the day. So just to kind of throw it out there, let's assume that you had a small credit card balance of maybe $8,000 or $9,000, right? And when we look at the costs of refinancing a first mortgage to give you that amount versus the costs of doing a home equity line of credit, it might make sense just simply to take the home equity line of credit. To Mike's point, which I think is really good, especially in today's world where people are staying in their homes longer, they're renovating their homes, they're working from home more often, we're seeing a lot more home improvements that are currently going on. And let me tell you, from somebody who has built homes, worked on homes, and renovated one myself, you really do never know how much that renovation is going to ultimately be in the end. To Mike's point, if that's something that you're looking to do, a home equity line of credit might make sense where you can go ahead and have a line amount similar to a credit card where you can pull out money as those renovations are occurring. At the end of that, we at Michigan First would be very happy to go ahead and consolidate that HELOC into your first mortgage for you at the lower interest rate that's fixed so that you don't have to worry about it in the long run, providing you options on both ends to help you renovate your home and go ahead and refinance to put yourself in a better situation. And that kind of circles back to Logan a little bit here. As there's many lenders out there that do these for their members and many banks, why should somebody choose Michigan First in regards to their home equity and what they should do with it?
Well, I would start by saying here at Michigan First, we are the financial experts, and I think what's very important about the way we conduct ourselves and the way we conduct business is between our mortgage team and between our direct lending team, we're all on the same team at the end of the day. And so if I'm looking at an application and I don't think that for any number of reasons, whether it's debt to income issues, whether it's issues with the property or deferred balance on a first mortgage, if I see something like that, I'm going to immediately start thinking, okay, maybe cash out refinance is the way to go here. And I'm not only just going to address the loan in front of me, but I'll actually line up a referral so that we can get a loan officer working on this opportunity immediately. And I think vice versa, we see a lot of equity loans that come over where they were actually referred, the member was referred by one of our mortgage loan officers because they thought that given the context of the person's financial situation or whatever was going on in life, that a home equity line of credit or even a term loan was best for them. And so they actually put them on the path to meeting us. And I think when you sit down with Michigan First, whether it's one of our loan office or loan bankers, our FSRs, or a mortgage loan officer in our mortgage team, they're going to be able to look at your credit report and they're going to be able to give you a very in-depth and a very detailed credit explanation, but not just an explanation, but a plan and how to move forward. And we're going to set you up for success. And we're going to get you in contact with whoever it is that you need to speak with. And we're going to try to get the ball rolling. And even if we can't do a loan today, if we can't do a loan on our direct lending team or even a refinance on a mortgage in that moment in time, we're going to set you up on some kind of plan with a follow-up date. And we're going to give you advice on what we need to see to make it happen. And we're going to try to get you there. Whatever your financial goals, Michigan First will get you there if you work with us.
Thanks for that, Logan. And that's true. We are all one team. Our goal is our client's success. I'd like to start wrapping it up and talking about the three takeaways that we would like to give our members in regards to today's call. And I'm going to hand it over to Mike. Mike, let's talk about those three takeaways that we'd like our membership to hear.
Yeah. So, kind of like what Logan was saying, but, a cash out refinance, it's a great option to lower your monthly debt payments, often provides the lowest interest rate over any other debt consolidation loan. And that's the thing too, as a loan officer here, when I ever am talking to somebody about a cash out refinance, I'm always looking to see, hey, is this maybe a better option for them to do a home equity loan? Are there other solutions out there as well? Because like Logan's saying, my goal is to put you in the best financial situation. And the other part of it, cash out interest rates are generally higher than a rate and term interest rate. So the other part of it, sometimes, you quote a cash out refinance, people get a little scared. I mean, it's not like a crazy high number for interest rate, but, with where the market's at, oftentimes when you do a cash out refinance, especially if you're going higher, if you're trying to leverage that 80% equity threshold, it's going to come with a higher rate. And it may make sense to do a rate and term refinance to get you back into a lower rate, up to 6 months later or even longer after. And I think like the biggest thing that I'll say too on this is if you're in a situation where a cash out refinance is going to make sense to consolidate debt, you really have to evaluate your spending habits because we run into folks all the time. We do a cash out for them. We think we're getting this person out of, serious amount of debt, putting them in a much better financial situation. But if you don't evaluate your spending habits, you're very likely to go right back into it. So it's really important. I mean, this is a good lifeline for you to pull that cash out of, pull that equity out of your home, but you have to evaluate how you're spending funds, and, doing a budget analysis, whatever you can do, and we can help you with that, is going to really make sense at that time.
Yeah, you make a good point. We are more than happy to go ahead and not take care of our members' financial needs, but also work with you in regards to how to budget and put yourself in a situation so you'll be successful after going ahead and closing with us. Logan, let me hand the ball to you. What are the 3 items that you'd like to go ahead and have our members hear?
Well, I think the 3 most important takeaways, at least from our position in the lending team, is just understanding the relationship between equity in the home, or equity in your home, and your financial well-being. Obviously, if you have equity to tap into, no matter what life throws at you, you're going to be positioned, and I hate to put it this way, but you'll be better positioned than the average individual to absorb an unforeseen expense or anything life could throw at you if you have that vital resource to draw from. And so building that financial stability, staying in the home, whether that's a few years down the road, and just building that equity over time, or maybe even making an additional payment here and there when you can afford to, you'll really thank yourself in the future if you ever have to draw from that equity. Because as we talked about earlier, that 80% threshold, that really can set some folks back when they don't have a lot of equity, or when they need to immediately tap it and they just haven't been there long enough to build up sufficient equity. I would say the other thing that the most important takeaway here, though, is always come to talk to us first. Sit down with one of our mortgage loan officers, sit down with a financial sales rep, because they're really gonna, if you don't know or have a good understanding or even a good idea of where you are financially in terms of what's right for you, sit down with us and just let us just lay it all out. Let us look at your credit report and give you an in-depth review, and we're gonna get you back on the right path.
Thanks for that, Logan. I appreciate both of you and their times today. If you would like to go ahead and reach out to Mike and or Logan in regards to any of the questions in regards to our presentation today, here is their contact information. Feel free to take it and contact it down. I know Mike also put it down there in the chat. We are more than happy to speak with you anytime, day or night, in regards to your finances, because our goal is your success. My name's Grant Spencer. Thank you again for joining us today here on our virtual homebuyer seminar about refinancing. Thanks again. Bye-bye.